Quantitative analysis is a data-driven approach to evaluating securities, focusing on numerical and statistical models. It uses financial data, market indicators, and statistical tools to make investment decisions. This method emphasizes objectivity and mathematical accuracy to identify trends, forecast prices, and assess the risk-return profile of securities. Key components of quantitative analysis. 1. Financial metrics. Quantitative analysis involves calculating and interpreting key financial ratios and metrics. Example metrics. Earnings per share. Measures the profitability allocated to each share. Example, if ABC Corp reports $10 million net income and 1M shares, EPS equals $10. Price to earnings, PE, ratio. Valuation metric comparing stock price to earnings. Example, a PE of 15 for XYZ Inc. suggests investors are willing to pay $15 for every $1 of earnings. Debt to equity, DE, ratio. Measures financial leverage. Example, a DE ratio of 0.5 for company Y indicates low reliance on debt compared to equity. 2. Risk assessment. Quantitative analysis evaluates risk using statistical metrics like variance, standard deviation, and beta. Example metrics. Beta. Measures stock volatility compared to the market. Example, a beta of 1.2 for Tesla indicates it is 20% more volatile than the market. Sharpe ratio. Measures risk-adjusted returns. Example, a Sharpe ratio of 1.5 for an investment indicates a high return for the risk taken. Value at risk. Estimates potential loss in portfolio value over a specific period at a given confidence level. Example, a 5% VAR of $1 million means there's a 5% chance of losing $1 million or more in a day. 3. Statistical models. Statistical tools are used to analyze historical data and predict future performance. Regression analysis evaluates the relationship between variables. Example, using regression to predict Apple AAPL stock returns based on historical market movements. Monte Carlo simulation simulates various scenarios for asset prices. Example, analyzing portfolio performance under different economic conditions. Time series analysis analyses price trends over time. Example, using ARIMA, autoregressive integrated moving average, to forecast S&P 500 index trends. 4. Portfolio optimization. Quantitative models help optimize portfolio composition to maximize returns for a given level of risk. Modern portfolio theory, MPT, focuses on diversification to minimize risk. Example, constructing a portfolio of tech and energy stocks to balance risk and return. Efficient frontier plots optimal portfolios offering the highest return for a given risk. Example, a portfolio on the efficient frontier might combine 60% equities and 40% bonds. Applications of quantitative analysis. 1. Stock selection. Quantitative screens filter stocks based on predefined metrics. Example, a screen identifies undervalued stocks with PE less than 15, debt to equity ratio less than 0.5, ROE greater than 15%. This screen might highlight stocks like Berkshire Hathaway or Johnson & Johnson. 2. Index tracking. Quantitative strategies track or replicate market indices using statistical methods. Example, using ETFs to replicate the performance of the S&P 500 index. 3. Quantitative trading. Quantitative algorithms execute trades based on data-driven strategies. High-frequency trading. Trades occur in microseconds to capitalize on price discrepancies. Example, arbitrage between futures and spot prices in the forex market. Algorithmic trading uses pre-programmed rules to execute trades. Example, a moving average crossover strategy where trades are triggered when the 50-day MA crosses above the 200-day MA. Examples of quantitative analysis in action. 1. Evaluating stock performance. Scenario, an investor wants to assess Tesla. Analysis, calculate financial metrics. EPS, $4.50. P/E ratio, 20, compared to industry average of 25. Evaluate beta. Tesla's beta equals 1.8, higher risk but potential for higher returns. Conclusion: Tesla is undervalued compared to peers, but the high beta indicates risk. 2. Portfolio diversification. Scenario: constructing a balanced portfolio. Analysis: use correlation analysis to identify low-correlated assets, e.g., tech stocks and bonds. Optimize weights using the efficient frontier. Result: a portfolio with 60% stocks and 40% bonds offers a Sharpe ratio of 1.2, balancing risk and return. 3. Predicting market trends. Scenario: analyzing the S&P 500 index for future trends. Analysis: time series model predicts an upward trend based on past data. Monte Carlo simulation estimates 90% confidence interval for future index levels. Result: forecasted 12-month return is 8% with a 5% downside risk. Advantages of quantitative analysis. 1. Objective. Removes emotional bias from investment decisions. 2. Data-driven. Provides insights based on measurable factors. 3. Efficiency. Useful for screening large volumes of securities. 4. Risk management. Quantifies risk using advanced statistical models. Limitations of quantitative analysis. 1. Dependence on historical data. Past performance may not always predict future outcomes. 2. Overfitting. Complex models may align too closely with historical data but fail in real-world scenarios. 3. Ignores qualitative factors. Does not account for management quality, brand strength, or market sentiment. Quantitative versus fundamental and technical analysis. Quantitative analysis is a powerful tool for evaluating securities, helping investors make data-driven decisions. By leveraging financial metrics, statistical models, and optimization techniques, it enables precise risk-return assessment and portfolio construction. While effective, it should be complemented with qualitative and market insights for a comprehensive investment strategy.